really going to have a day of reckoning? You're saying that the math isn't adding up.
They criticize me. They come on my YouTube channel and they fill up my comment section. They say, Dave, you've been warning people that tax rates are going up, but all they've done is gone down. But I'm telling people they got about 10 years until about 2035.
There are some people that are saying Roth IRAs could get taxed, that the government will go back on their word.
There's no catching up here. You either decide to give the IRS their own money today, or you give the IRS their money somewhere down the road when it's a bigger pile, but never at any point does that money become yours. The only way to truly insulate yourself from the impact of what's likely to happen between 2035 and 2043 is to...
If you believe that taxes will increase or could increase, what should you do about it today?
I recommend to people that 30% should go towards a volatility buffer. As you say, tax rates in the future are going to be higher than they are today. Therefore, I must just reflexively convert all of my money to tax-free. Well, that isn't necessarily the case, and here's why.
David McKnight, welcome back to the BetterWealth Show.
Thank you, Caleb, for having me.
It's 2026. Lots of exciting things are happening. Trump has definitely stirring the pot. I feel like every week we could have you on and we could just react to what Trump is saying. But the reason I reached out originally is you've had a couple videos on Roth IRAs. There's been questions around, okay, do Roth conversions make sense? Should we be contributing to a Roth? Even if you can qualify for a traditional Roth or backdoor Roth, like, should that be something that you should consider? I've talked to someone recently that said Roth IRAs potentially could get taxed at the state level, even though they're pretty sure that it would be almost like political suicide for someone to, take it away from the federal level. So there's a lot of questions there. And I can't think of a better person to almost create like a 2026 tax masterclass for us to talk about those things. And then also life insurance has been known and as stated as like the rich person's Roth, and like how you're thinking about life insurance, Roth, and other tax-free vehicles. And so with that, welcome to the show.
Thanks. Look forward to chatting about all this stuff. It's going to be good for strategy moving forward, particularly in light of the OBBBA. I think there's a lot of good stuff to talk about there.
Cool. So with all that, do you want to start with the OBBA? Where would you like to start when it comes to this conversation?
Yeah, I think that really the conversation has changed a little bit since the OBBBA happened. I believed, as many of us did, that the Trump tax cuts were going to expire January 1st, 2026, and that they were going to be extended through budget reconciliation for 8 years. There was going to be a sunset. And the reason why you could only do it through 8 years is because they weren't going to really be able to demonstrate over a 10-year window that it wasn't going to increase the debt. And according to the Committee for a Responsible Federal Budget, it's going to increase the debt anywhere from 4 to 5 trillion. So what the Republicans did was they basically said, we're going to pretend like all of that additional spending under the TCJA was just the new baseline. So it's sort of like going on vacation, spending an extra an extra $1,000 per week, and then coming back home and then trying to convince your wife that all that extra spending that you did on vacation is actually the new normal, and then any additional expenses should be measured from that point forward. So that's what the Republicans did. And they said, the Tax Cut and Jobs Act became the new normal. So any additional debt should be measured from that point forward. And that's not really how math works in the real world, but that's what they did. And so they were able to make the case that the new extending the tax cuts permanently was not that did not have a cost to it. And so now we found ourselves in a situation starting July 4th, 2025, where the tax cuts have been permanently extended. Now, as you well know, Caleb, there's no such thing as a permanent extension of tax cuts. The IRS tax code, by its very nature, is written in pencil. So it's just a question of time before this changes. And so the question becomes when. If it's not going to expire at the end of 8 years, when is it going to expire? And I really think that it's when you're doing things like Roth conversions and setting out a Roth conversion strategy, you need to know how long you have, because how long you're going to stretch your IRA, over how many years you're going to stretch your IRA, is a pretty important part of your strategy. Say you got $1.5 million that you need to get converted over. You need to know how much time you have, which informs, into what tax bracket you're going to bump, so on and so forth. So I've been very thoughtful about this. I've talked to a lot of different experts, people that we all know, Ed Slott, David Walker, so on and so forth, and read what a lot of the experts are saying. And I really believe we got about 10 years before the fiscal condition of our nation is going to constrain tax rates to go up. There's a very important study out of Penn Wharton that happened in 2023, which basically says that if we don't right our fiscal ship of state by 2043, that no combination of raising taxes or reducing spending will arrest the financial collapse of our nation. And the reason they say that is because by 2043, the debt to GDP will be 200%. And that means that there's just so much debt. The debt has snowballed to the point where we just can't get out ahead of it. And it's just growing so quickly that you could raise taxes to 100% and it still wouldn't arrest the collapse of our country. And so I think that by 2035, politicians are going to have to start to begin the process of raising taxes to forestall that eventuality in 2043. They're even saying that as soon as 2040, when the debt to GDP is 175%, that we could hit that sort of crisis moment. So I think we got about 10 years during which to take advantage of these historically low tax rates. And I think that while we don't have the same definition and the same certainty that we had under the Tax Cut and Jobs Act of, hey, this is going to expire in 8 years, I think that we can count on there being about another 10 years of historically low tax rates, even if Democrats were to gain power in the next 3 years, that gain the White House and gain control of the House and Senate. I don't think that they would raise taxes on those people making less than $400,000. And when I make Roth conversion recommendations, it's typically not to go beyond the 24% tax bracket, which reaches about that $400,000 level. So I think that no matter who's in power over the course of the next 10 years, that we're going to be able to take advantage of these historically low tax rates for the purpose of executing these Roth conversion strategies.
So your take is pretty simple. It's hey, we can talk about planning, looking at today's rates, and I see this a lot where people just overanalyze. Like they almost get way too analytical, and they're not thinking in macro. They're almost assuming that nothing's going to change, and you're just taking a step back and you're saying, we're like, we have a train that's an analysis, and the train's it's getting closer and closer, and there's going to be an inflection point that something's going to have to change big time. Sometimes it's even hard. I mean, I'm 29 years old. Sometimes it's hard to even imagine that that's going to happen because it seems like we're just good at just continuing to punt, print money, don't worry about it. And so it's almost thinking like, as an American, like, is that really going to happen? Like, are we really going to have a day of reckoning? And you're saying that the math isn't adding up. And one of the best diversification tools that you can have is not being subject to potential massive hikes in taxation. And so you're assuming in the future that taxes have to go up, or I don't want to put words in your mouth, but like almost would have to go up to solve this issue. And so your best form of diversification is making sure that you're getting less money in places that could get affected by that.
Yeah, and I think you make a good point. A lot of people say, look, well, people have been warning about higher taxes for years. Ed Slott in the forward for my book, by the way, The Power of Zero is going to be updated and revised in April, and Ed Slott has updated his forward for that book. He says, look, I've been telling people for 20 years that tax rates have to go up. And so, and I likewise have been doing it for the last 15 years or so. And people say, Dave, you've been warning people. They criticize me. They come on my YouTube channel and they fill up my comment section. They say, Dave, you've been warning people that tax rates are going up, but all they've done is gone down. And I say, well, that's true. Tax rates have stayed at historically low. And if you could look me straight in the face and say, Dave, that happened while the debt stayed absolutely level or even went down, I'd say, hey, you probably have a good point. But all they really did was throw all that money that they should have been charging Americans, they've thrown it on the national credit card, and the debt has just gone nothing but up. It goes up $2 trillion per year over the next 10 years. It'll go up $3 trillion per year every year after that. And so at some point, and I think what the Penn Wharton study brought into sharp relief was that at some point you can no longer kick the can down the road, and they're telling us it's 2043. And so I think really the only way to truly insulate yourself from the impact of what's likely to happen between 2035 and 2043 is to systematically reposition your highly taxable 401ks and IRAs to tax-free. And you obviously don't want to do it all at once. You want to do it systematically over time to keep yourself in a low tax bracket. But the point is, this can't go on forever. And I think you rightly point out that this insanity at some point in time will come to a head.
Is even weird to me that, okay, Trump is, trying to get money from tariffs, but then is talking about how that's going to then get passed on to the American people. And I'm like, I want to be the guy that's like, okay, hey guys, do we have a big debt problem? Like, I know it's probably not going to win any political favors to just do the Dave Ramsey snowball method here, but like that might be something we want to look into. Even like the Trump accounts, great. And yet like that's an immediate thing that can maybe have his name on something and maybe helps with political, but it's like, shouldn't we build an economy that, babies born today will thrive 20 years from now, 15 years, like that's the kind of thing that I'm like, because a Trump account and all these things sound really good, but I'm seeing this as like any pluses or green that we have, we're almost like passing that back on, and it's like we're not even addressing the real issue. Do you find that both parties, Republicans and Democrats, are just kind of like rearranging, furniture on the Titanic, or is there anybody that in politics right now outside of like Thomas Massey that's like having which by the way, Thomas Massey's amazing. He's got the pin that like shows the debt clock. I wish more people in Congress and in the Senate were like that. Is there anybody relevant that's talking about this, or do you just see that people are putting their head down? Is it going to be like the hot potato where like somebody is going to get caught and we're hoping it's the other side that have to make like really hard decisions, not because they want to, but because they're forced to?
Yeah, there's a couple of smaller players. Tommy Massey's certainly one of them. We interviewed a number of them, and I forget all of their names. There's a congressman out of California. His first name's Thomas. Anyway, there's a number of smaller players. Mitt Romney, believe it or not, for conservatives, he's always like a swear word because he seems to be creeping over to the left, or at least he did while he was in office, but he was actually leading the charge on a lot of this. He really sort of sounded the warning cry on the debt. And he's written a number of opinion pieces and prominent periodicals about the debt and how we're really sort of stealing from our kids' future. And I think that you make a good point. It's great to have Trump accounts, but the real important thing that we need to put a premium on is bequesting a future economy to our children and grandchildren where they're not going to have to pay 50% in tax. I've done videos where I talk about, hey, look, in Denmark, you pay 50% tax, but you actually get something useful in exchange for those 50% taxes. You get universal health care, you get
Hmm.
paid vacation, you get maternal leave for a year, you get all these great things in exchange for that 50%. What are we going to get in exchange for that 50%? Zippo, because it's going to go to pay for the national debt. And
Yeah.
so I think that we need to think about the future with an eye towards what are our children going to inherit from us? And hopefully it's not a 200% debt to
Yeah.
GDP.
Okay, so with all that said, let's now talk about the master class. If you believe that taxes will increase or could increase, what should you do about it today? And before we get into that master class, I want to just ask you about the Roth IRAs. There are some people that are saying Roth IRAs could get taxed, that the government will go back on their word. Some people saying the federal government won't go back on their word, but the states, California, will easily be able to tax that because there's some loophole. You still have to file that you're taking this income. Why would you have to file if no one cared about it? These are some of the talking points. In your opinion, is that something that we should worry about at the Roth level?
Yeah, I mean, there's all sorts of possibilities down the road that you could worry about. I've always been a big fan of working with the tax code as it currently stands. And the tax rates can ebb and flow, but that's not the tax code itself. The tax code itself says you're either going to be taxed on the seed or the harvest. And currently, when you put money into a Roth IRA, you're being taxed on the seed. You're using after-tax dollars that's growing tax-free, and we've been told by the federal government that you're going to be able to take that money out tax-free. Now, I think states are a different question. And let me just say that as a country and as individual states slide slowly into insolvency, and many countries are. Connecticut, California is not doing great. There's a number of states that are not doing well that may reserve the right to start taxing Roth IRAs. I think that's possible. But let's look at the reality. The reality is they have made a promise. We are either going to tax you on the seed or on the harvest. If they were to tax you on the seed and the harvest, that goes back on the promise. And frankly, there's, roughly $45 trillion in the cumulative 401ks, IRAs, and other tax deferred investments all across America. And you've only got about $1 trillion to $1.5 trillion in Roth accounts. And so where's the target here exactly? Where are the
Yeah.
crosshairs? I think the crosshairs are trained squarely on those $45 trillion in IRAs and 401ks, 457s, et cetera. And so I think they can either go back on their promise of either being taxed on the seed or the harvest, or they could simply say, let's start targeting this $45 trillion. We've never made the promise that we weren't going to raise the taxes on those investments. And so let's raise revenue by starting to tax the harvest at a higher level. So I think that's what we're likely to see. I don't think that politicians gain much. I mean, certainly raising taxes on your 401ks and IRAs is politically unviable, but I think it's even more unviable to say, hey, let's tax you on the seed and the harvest and get a lot of people worked up when there's really not that much revenue to be had from it.
I see. I love how you broke that down. It's like supply and demand. It's like where's the gold? It's like the golden rule. Those who have the gold make the rules. Those who have the gold get all the attention. I even think about like game theory, and sometimes you want to be like discreet, like you don't want to have everyone look at you, and so like there's an aspect of that. Okay, so you talk about this tax. I'm assuming they're not going to apply any new tax to retirement accounts. It's literally going to be in the form of income tax and potential thresholds that come down. That's another thing, that it's easy to raise taxes without getting political. It's just lowering the thresholds and all. And so is that what you're proposing, that you believe income taxes in general are going to increase, or the amount of tax that we have to pay through income tax? And because money is in traditional 401ks and IRAs, that's income, and it's very much the same as you earning income in your job. Is that what you propose, or do you think there's a new tax out there that people need to be aware of that would just affect people that have money in these qualified plans?
Yeah, I don't think that they're going to specifically raise the income tax level because they're like, we need to get our hands on this $45 trillion of pre-tax money inside 401ks and IRAs. I think they're going to say, not only do we need to tax all of those accounts, we just need more revenue in general. We need to tax people's income. And because those types of accounts fall under that purview, then that's going to be one of the consequences. But I think that they're going to say, look, we just need more revenue. We can't pay the interest and all this mounting debt. And there are consequences if a federal government starts to miss interest payments. I mean, it's calamitous. It sends shockwaves across the global economy. Interest rates start to go through the roof because now all of a sudden foreign countries don't believe that we can pay back all that debt, and so they're going to charge us more. People don't realize that the national debt renews every couple of years, and it goes to these auctions, and people bid on what they're willing to pay for the national debt. And if you've struggled to pay the interest on your national debt in the past, they're going to say, look, I'm not going to charge you 3 or 5% anymore. I'm going to charge you 10% because we have to cover our backsides based on your track record. And so there's all sorts of consequences when we fail to pay the interest on our national debt or default on our debt, which is actually against the Constitution. So we're going to be forced to take really, really drastic measures. And I think that they're going to need to raise taxes on the whole pie. And that includes 401ks, IRAs, and everybody's income.
Okay. With all that said, now let's talk about the master class of, if you believe that that this could be happening or will happen, or there's even a chance that happens, what is the framework that we should be applying to our wealth, the money that we've already saved up and invested? And then let's also speak to the person that's just starting to invest their money or just starting to plan. They might have 30, 40, 50 years of future unknowns. Speaking to myself here, how should I be thinking about this as well? So let's please take us through like the master class.
Okay, let's start with the young people. The farther you are out from retirement, the more likely that your tax rate in retirement is going to be dramatically higher than they are today. I could point you to a USA Today article that says the younger generations can look forward to giving up 50% effective tax rates on their income. Why? Well, if Caleb, if you're 29 and you're going to retire in 30 or 35 years, just look at where the debt's going to be at that point. Look at what the debt to GDP will be at that point. Look at how much interest we're going to have to be paying and servicing. So it's just really a mathematical equation. At a certain point, the math gets so adversarial that you have no choice but to pay those higher tax rates. The government will be forced; they'll be constrained to raise taxes. So the farther you are out from retirement, the more those mathematical realities constrain the federal government to pay tax or to raise taxes. Now, for people who are getting ready to retire, there's always three considerations that I say. The first one, well, there's even more. I'll get into the three things that should inform your Roth conversion strategy. But the first question you need to ask yourself is your tax bracket today higher or lower than the tax bracket you're likely to pay on those retirement assets when you take the money out? It's a simple question, okay? You have to be able to answer that question before you proceed with your Roth conversion strategy, if you do one at all. So if your tax rate in the future is likely to be higher than it is today, even by 1%, then you should proceed with a Roth conversion strategy. Okay, so that's the first question. People do all these different things. I did a video recently debunking this. They say, well, do I have enough years to catch up for all the tax I'm paying today? Folks, when you pay tax, you got to think of your IRA as two piles of cash, a pile of cash that belongs to the IRS and a pile of cash that belongs to you. There's no catching up here. You either decide to give the money to the IRS their own money today, or you give the IRS their money somewhere down the road when it's a bigger pile, but never at any point does that money become yours. And so this whole catch up and this crossover doesn't really make sense, and the math doesn't really bear it out. The real question is, will you be in a tax bracket that's higher in the future than it is today? So that's the first thing that you got to ask. If the answer to that question is yes, then you have three other questions that you need to ask yourself. The first one is, how much of my IRAs or 401ks or other tax deferred accounts should I convert? That's the first question. Because if you don't know how much you should convert, then you don't really have a basis for making a plan. And I'll give you an example. A lot of people say, oh, tax rates in the future are going to be higher than they are today. Therefore, I must just reflexively convert all of my money to tax-free. So I got $1.5 million in my IRA. I should just convert it all to tax-free. Well, that isn't necessarily the case, and here's why. When you retire, you're going to have a standard deduction, and that standard deduction says that you can realize income from any number of sources up to whatever that standard deduction is without paying tax. And historically, the federal government has indexed that number to keep up with inflation. So, for example, if I retire in 15 years, my standard deduction is going to be closer to something like $50,000. That means I can realize income from 401ks, IRAs up to $50,000 per year without paying any tax at all. And so the bottom line is, you want the balance in your tax deferred bucket to be low enough so that required minimum distributions are equal to or less than your standard deduction, but probably also low enough that they don't cause Social Security taxation. So I'll make this easy for most people. For married couples, you want to have between $400,000 and $450,000, and for single people, about half that amount. And so that's the first thing that you need to figure out is how much money should you keep in your tax deferred bucket? Because if you convert all of it, then you're going to have a standard deduction that sits idle in retirement, and then what does that mean? It means you paid more tax along the way than you really needed to, which means you're going to run out of money faster than you really had to, and that's a tragedy. So that's the first thing. The second thing is, okay, now that I need to know that I've got $1.5 million, I need to convert. I need to get it down to 400,000. That's $1.1 million that I need to convert. The next question is, how much time do I have before tax rates go up for good? In other words, if we look in our crystal ball and say, how much runway do I have before the deadline hits? And that's why I'm trying to tell people that you can never be too certain about this, but I'm telling people they got about 10 years until about 2035. And so that tells us, you really want to stretch that tax obligation over as many years as possible. You want to convert that money slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting before tax rates go up for good, which I think is going to be in 2035. And then the next question is, okay, now that we know what our target is for how much we want to have left in that IRA or 401k, we know when we want to get that conversion done by. The next question is, how much are we going to be converting per year? And that can also be informed by which tax bracket do I believe is a good deal of historic proportions versus what isn't. And I think if you look at the 2018 version of The Power of Zero, chapter 6 talks about how the sweet spot and the Trump tax cuts is the 24% tax bracket. And I'm here to tell you that because those Trump tax cuts got extended permanently, we now believe that 24% tax bracket is going to be around for another 10 years. And so, that means that between the top of the 22 and the top of the 24, you got about $190,000 of shifting space. And so the reason I love the 24 is because, hey, look, if we were saying, hey, tax rates are doubling and you're in the 12% tax bracket, and I try to convince you to jump up into the 22, I'm basically saying, look, in an effort to protect you from a doubling of tax rates over time, we're going to double your tax bracket in the short term. But guess what? Most Americans that I talk with day in and day out are in the 22% tax bracket. Well, if they're already in the 22, what we're suggesting is that they bump up into the 24. So for a measly 2% more, they can convert an extra $190,000 to tax-free. And it only costs them 2% more on the margin. And so in summary, our tax rates, do you think your tax rate in the future is going to be higher than it is today? How much money should remain in your IRAs and 401ks? When do you think tax rates are going up? And how much should you be converting per year, every year between now and 2035?
And the 24%, how did you get to that number? Is that just based on how did you back into that 24% number?
The reason I like the 24 so much, and I used to be able to say this easier before the Trump tax cuts got extended, when they were going to expire, in 2026, I used to be able to say, look, the 24 is still lower than the future version of the 22, which is 25. Right. So why would you let a single year go by where you weren't maxing out your 24? But the other reality of the 24 is that if you bump up beyond the 24, it goes all the way up to the 32. So that's 8 percentage points, but it's really, if you think about it, it's a 33% increase in your tax bracket. So, so just because the leap between the 22 and 24 is so microscopic compared to the leap between the 24 and the 32. And that's why I think 24 really is the sweet spot.
Okay. So if you're dealing with someone who's, 10 years, 15 years out, I think these 3 steps are really, really powerful. For someone young, do you even think the standard deduction, based on your logic of the train's coming and things are going to have to radically change, how many years out do you just put off hey, don't even worry about the standard deduction? For example, Social Security. Should I be planning that Social Security is going to be around? Personally, I'm not. It'll be a cherry on top, but I think it would be crazy for me to be able to do planning based on Social Security that may or may not be funded, or who knows what it's going to work. When it comes to standard deduction, do you think that could be something that could easily be attacked? Because I see that being way easier to attack, increasing revenue than raising taxes. Because they didn't raise taxes, but they got more money.
Yeah, you eliminate the standard deduction, you're effectively raising your effective tax bracket. So you get more income tax at these higher levels, so your effective tax rate goes up, even though they maybe didn't really fiddle with the tax brackets themselves. So there's 2 realities. One is that it could go away, and the other is, what do you plan for, right? What do you do today? Do you plan that based on it's not going to be there? I don't think I can quite make that leap. So I'm still telling people that you're likely to have a standard deduction. We've had a standard deduction as long as I can remember in my lifetime. It's always been indexed for inflation. I don't think that's going away. I think that the poorest among us benefit from the standard deduction, obviously the most, and they still vote every couple of years, and so I don't think that's going away. So what they did back in 2018 was they eliminated exemptions, but they increased your standard deduction, and they acted like they were doing you a favor. And so I think you're right. A lot of times what they do is they eliminate they eliminate exemptions in certain areas. They increase deductions in other areas, and then they make it look like things are going really, really well and that you should vote them back into office. But that's not exactly what happened. And so I think that whether they're raising taxes or eliminating deductions and exemptions down the road, I think that they need more revenue. And whichever way you want to slice the apple here, they're going to need more revenue by whatever name they call it. And so the net effect for Americans is that they're going to have to pay more tax, whether it's an increase in their in the income ranges that affect tax brackets, or decrease, or an increase in the tax brackets themselves. People are going to have to pay more tax because the math doesn't add up otherwise for a sort of a sustainable, federal budget.
Yeah, and just to recap what you're saying, if someone really wanted to be like total fear bait and just be like, okay, taxes are going to the moon, they're going to take our money, you could just transfer everything into tax free. But what you're saying is, with what you believe to be true, even with knowing that taxes are going to raise, I mean, you still have to keep people, like, you can't be crazy drastic. So you can increase taxes, but I don't think you can go to 90% and still think that we're going to have America the way it is. And so you're saying we still got to be strategic with the standard deduction. For example, if you transfer everything into tax free and you have that deduction that's not able to be used, you're being inefficient. In ironically, you're actually paying more tax that way. And I would imagine that your framework is saying we want to pay as little tax as possible, but you have to zoom out, because some of the reasons why people don't love Roth conversions are, number one, you have to pay tax in that year, so that's something. But then the other thing is advisors. There's like an incentive against it, because if you're getting paid off of assets under management, I'm proactively lowering the amount of money that I can charge a fee off of, and so that's another ironic thing that happens. And I'm not saying there's a lot of great advisors out there. I'm just saying, like, the reason why Roth conversions can be like, maybe like the pushback could be those two things. It's like, no one necessarily wants to pay more tax in that year, and then number two, your account is being smaller, even though it's like it's more of your money, so it's all relative. You're gonna have to pay that someday. But I don't actually think, when people think of their 401k balance or their traditional IRA, they see that gross number and they see it as their money. Whereas, like, you have a mentality, I have a mentality of, like, depending on where that money is, I'm in partnership with somebody that could change their equity stake at any time. I know I threw a lot at you, but is there any other reasons why Roth conversions aren't talked more? Because there's many advisors that I know personally that don't love Roth conversions, and they have their talking points. I want to give them the benefit of the doubt. I'm just wondering why this is not more of a common practice.
Look, I don't have a problem if financial advisors say, "Look, I don't think Roth conversions make sense mathematically," but as long as they have a good explanation for how the federal government's going to liquidate all this debt over time, and I've gone the rounds with them. I've gone the rounds with, for example, the white coat investor. We had a huge online blog debate years ago where he told people not to read my book, The Power of Zero, because it was insane to think that tax rates down the road were going to be higher than they are today. Say tax rates tend to ebb and flow with time based on the exigencies of the federal government, but they're not ever going to. They're not ever going to be. You can't bank on the fact that they're going to be higher in retirement. And then, interestingly enough, in the lead up to the 2020 election, he said, "Hey, I just saw Joe Biden's tax plan, and it reads like an all-out war on the individual investor. If Joe Biden gets elected, I'm going to convert my entire IRA to Roth all in 1 year." So, of course, he made this comment on Twitter, and I chimed in. I said, "Glad to see you're coming around." At which point he blocked me. But the point is, I think more and more people are coming over into our camp, saying, "Look, I think that it's obvious, the handwriting's on the wall, that tax rates down the road are going to be higher than they are today." And so, um, let's talk a little bit briefly about why major money management institutions don't want to talk about this stuff. You touched on it, and rightly so. If they're managing $1 million of your dollars and they're charging 1% per year, they're making 10 grand per year off you. If they were to persuade you that tax rates in the future are going to be dramatically higher than they are today, you might just feel impressed to shift that money to tax free. And what are you going to have to pay along the way? Tax. Let's call it 30%. So now you got 700,000 in your Roth IRA. If they're still charging you 1%, now they're only making $7,000 per year off you. And didn't they just experience a pay cut for persuading you that tax rates in the future are likely to be higher than they are today? And for that reason alone, most major money management institutions don't want to touch this conversation with a 10-foot pole. And me personally, I don't care how much money somebody has. The only thing that really matters is how much they get to spend after tax, which leads me to my second point. What are we all really trying to do here? We're trying to increase the likelihood that someone's money lasts through life expectancy. And whatever combination of little strategies and tweaks that you can make along the way that can increase the likelihood that your money is going to last through life expectancy, then those are the things that you should employ. And if one of those things says, hey, I should leave some money in my Roth IRA or in my IRA and not convert it because I'm not going to have to pay tax on that money because I'm going to be able to take it out tax free because it's going to be absorbed by the standard deduction. That is something that can increase the likelihood, even if ever so slightly, by 2 or 3 percentage points, that your money will last through life expectancy. Then it's certainly something that you should consider doing.
What's been the best counter argument to yours around where you're like, okay, that's a good point. I hear you. I might disagree with what you're saying, but have you heard any counter arguments to why you wouldn't want to convert, or why taxes aren't going to go up in the future?
I haven't heard any really good arguments. I'll tell you the most common argument I get is that they'll be able to just print their way out of the problem. And here's the big issue there is the two biggest issues over time where we have the $239 trillion underfunding over the next 75-year window. It's according to Dr. Larry Kotlikoff, it's Social Security and Medicare. Social Security, Medicare, and Medicaid. And the problem is when you print more money, what happens to inflation? It goes up. And every single one of those programs is linked to inflation by law. In other words, they have to go up. They have to increase with inflation by law. It would take an act of Congress to make it otherwise. And so you increase the money supply, that increases inflation, it increases commensurately the cost of these other programs. It's sort of like a dog chasing its tail. It never really catches up. And so that's the argument I hear the most. It was very eloquently debunked by a professor out of UC Berkeley in our movie Power Zero, the tax train is coming. And so it's just it there's really no way out of it. And so no argument really stands up to scrutiny, which is why it's easy to answer that question. Say, look, there aren't any really good arguments against it. It's like a tax freight train bearing down on America. And the only thing you can do is sort of get yourself off the tracks.
Yep, and I appreciate you mentioning those incentives because I think that is something to think about. It being in the insurance space, a lot of people like to attack the insurance space by, you guys get paid a commission, you must be, not be giving the right thing for people. And I think that's valid. I think there's a lot of people on any sector, including the life insurance space, including the annuity space, that you could easily paint as like, yeah, not doing the right thing for clients because of money. But just because you're a fiduciary, just because you don't do insurance or annuities doesn't give you a pass either. I think if you understand incentives, isn't Charlie Munger the one that like, show me the incentive and I'll show you the outcome? I think that needs to be factored into even who you're talking with. With all that said, life insurance is a big part of what you talk about because there's only so much you can do when it comes to Roth conversions and all. Where does life insurance fit into your overall, framework in helping people be as efficient as possible with the amount of money that they can spend in the future?
If you're a high-earning professional, entrepreneur, or someone who wants more control of your money, we offer something called a clarity call. It's a one-on-one conversation where we learn more about your situation and walk you through how integrating whole life insurance could help better your financial situation. It's no pressure or fluff, just real clarity on whether this strategy is right for you. Click the link in the description or tag comment below, and we'll walk you through exactly how we can help you.
Yeah, generally, when I recommend life insurance, particularly cash value life insurance, it's as a volatility buffer in retirement. So I'm generally telling the younger generation. In fact, I got a book coming out called The Secret Order of Millionaires. It's sort of a financial parable that outlines 7 principles for building tax-free wealth. And one of the principles is go tax-free. So if you can invest in Roth 401ks, Roth IRAs along the way, you really only need to invest in 2 types of funds. 70% of your money should go towards a total U.S. stock market index. 30% should go to a total foreign or international stock market index. It's really all you need. And then rebalance every time it gets 5% out of whack. So that should be 70% of your retirement savings should go towards the combination of those 2 types of investments. But where should the other 30% go? I recommend to people, especially the younger generation, in my book and elsewhere, that 30% should go towards a volatility buffer. What does that mean? Well, we've all heard of the 4% rule. Why does the 4% rule exist? It exists because people want to know, what amount of money can I take out, rain or shine, out of my portfolio, adjusted for inflation every year, and have a high likelihood that my money will last through my actuarial life expectancy. Bill Bengen, in 1994, came up with the 4% rule. He was sort of scandalized that people were taking these 7 and 8%, rates of distribution. And back then, people would say, "Hey, what's the stock market doing?" And whatever answer they thought was reasonable, that was the amount they would take out of their portfolio. So if they thought that the stock market could do 7%, then they would take out 7% withdrawal rates per year, which is crazy, And so Bill Bengen decided to put some pencil to paper, and he did some simulations, and what he found was that even 5% withdrawal rates had 50% fail rates over time. And so he settled on the 4%, which, you can argue whether it's 3 like Tom Hegner, 4.7 like Bill Bengen now argues. But 4% has sort of been the gold standard for distribution rates over the last 40 years or so. And so the question is, are we inextricably linked to that 4%, or is there a different way to get more money out? And the reason 4% exists is because when you're in retirement and you take money out of your stock market portfolio in the year following a down year in the market, then that could send your portfolio into a death spiral from which it never recovers. And basically it said, how low can that distribution rate go without having to worry about having our money go into a death spiral? And that's where the 4% rule really shines. Even if you have a down year and you're just still taking money out, you have a high likelihood that your portfolio will last through a full 30 or 35 year retirement, even if you're taking money out after those down years. You start taking out 5 or 6 or 7 or 8, then that's a whole different ballgame. So what we found, and what a lot of smart people have found, I've got calculators that I built around this, is that if in the year following a down year in the stock market, instead of taking money out of your stock market portfolio, you take it out of a safe and productive growth, a safe and productive account that's growing tax-free, that can't lose money in the market, live out of that account in the year following a down year in the market. And what that does is it gives your stock market portfolio a chance to recover before you take further distributions. So if you can wait until your stock market portfolio recovers, sometimes it takes only 1 year, sometimes it takes 3 years, sometimes it takes 5 years, but you wait until your stock market portfolio recovers before you start taking further distributions, then that can actually increase the sustainable withdrawal rate on the stock market portion of your portfolio to as high as 8% with a 95% confidence rate that it'll last through actuarial life expectancy. And so really, how I recommend using cash value life insurance is you save 70% of your money towards the stock portfolio, no bonds. I don't believe in bonds. 30% towards cash value life insurance as that volatility buffer. And there's been a lot of studies that have come out from Ernst & Young that bear this out, whether you use an IUL or whole life, that the math works out. And you take the money out, you live off of it, and then when your stock market recovers, you can either pay the money back to the cash value life insurance, or you can leave it in there depending on what type of loan rates you have. So that's really how I recommend it. And then the other thing that I love about cash value life insurance is that with many of these policies these days, you can receive your death benefit in advance of your death for the purpose of paying for long-term care. And if you die peaceful in your sleep 30 years from now, never having any long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So there's not that sensation of having paid for something you hope you never have to use. So those are really the two applications in which I really recommend using cash value life insurance in retirement.
How did you come up with the 30% number, 30% to life insurance, 70% to the indexes?
In the scenarios that I've simulated, that seems to be what works out the best. And it's also coincidentally the number that Ernst & Young used. They say put 30% of your retirement savings towards the cash value life insurance. And this is how, so Ernst & Young did scenarios where they said, let's use annuities, let's use cash value life insurance and investing, and compare that to the investing only alternative. And they said you get more income, higher likelihood your money lasts through life expectancy, and more money to the next generation when you use the insurance products versus investing alone.
How many years of volatility buffer do you think is optimal?
5.
5. Okay.
Yeah.
And
the reason that is because according to my math, the more years you have, the higher the sustainable withdrawal rate and the higher likelihood your money will last through life expectancy. It's just a mathematical, because remember, if it takes you 5 years, like maybe it did during the decade of the 00s, the 2000s, If it takes you 5 years for your money to recover before you can take further distributions, if you don't have 5
Yep.
years, you only have 3 years, you're still going to have to take money out while
Yep.
your money's still underwater. And so it's just 5 years is really optimal.
But and the reason it's not 10 is there's opportunity cost of not having your money in the market. So you could have 30 years of volatility buffer, but then you're missing out potentially on growth rate, on the opportunity of your money growing. Da- David did not talk to Dr. Wade Fowle before coming on the show and say, "Hey, what did you say?" Dr. Wade Fowle gave me a very similar answer, by the way. I think there's something powerful about that 4 to 6 years, and understanding how that works. And then obviously life insurance, the more that I learn, the less hypey I get. I sometimes cringe at my younger self as I wrote a book and all, and yet my conviction for life insurance has only increased. But it's just I've learned, I've been able to take a step back and say, hey, this is the word I use is integration. When integrated, it can be really, really powerful. When it's just standing alone, it's vulnerable. And so what is your take on the many people that use your book and your teaching to sell all of your money should go into a life insurance? I see this more with IULs, but I see this in whole life as well. And then they show the loan function and arbitrage, and you're seeing income. They call it income, even though it's technically not. And it looks incredible. And they gaslight you for trying to challenge that, or saying like, hey, this might be an over exaggeration, and now they're educating you. I'll have one other thing and then I'll let you talk. I talked to someone who's pretty well known. He didn't know necessarily who I was, and he was talking to me, and I've been pretty clear that we do more whole life, but I'm not against any one thing. And I was sharing a little bit of our business model. He jumped in. He's like, here, I'm going to educate you on how IULs work. And we're like going. And he's like, I bet you didn't know this. And I didn't say, I wouldn't want to hey, I have a YouTube channel. I wasn't born yesterday kind of deal. But it was just a whole and his whole deal is you put all your money into this thing. And he also is teaching premium finance. So he's going to the next level and saying not only this, but people should be leveraging money to do that. And on the illustrations, I wouldn't disagree. They look amazing. No rational person is going to say that number's not great. I think it's the challenge of how likely is that going to happen? What is your thoughts on the people taking your information, your book, and then having people put all their money into IUL or whole life for the idea of income or tax exempt cash flow, which they will say that's off the radar screen of the IRS, and you'll get more income and still have a death benefit in the process?
Yeah, anybody who thoughtfully reads my books, any of my books, frankly, would never come away from any of those books with the conclusion that all you should ever invest in is life insurance. And so in a biblical studies context, there's a word called proof texting. And proof texting says, I'm going to take a verse from the Bible and I'm going to strip it of its context, strip it of its meaning, and use it to wield as a weapon against someone else's faith. That's what they're doing with my book. They're proof texting it. They're taking maybe a chapter out of it. They're stripping it from its context, stripping it from its broader understanding, and they're saying you should put all of your money into cash value life insurance, when that's actually the 180-degree opposite of what I've been preaching for the last 15 years of my life. So really, I try to make the case, and whether I'm speaking or through my books, that this life insurance alternative only really works when used in concert with all of the other sort of streams of tax-free income that the IRS tax code allows for. We're looking for a broad, comprehensive approach to tax-free retirement planning that takes advantage of every nook and cranny in the IRS, every tax-free nook and cranny in the IRS tax code. I mean, we're talking Roth IRAs, Roth 401ks, Roth conversions, taking money out of your IRAs up to your standard deductions, cash value life insurance. And then if you can keep your provisional income low enough, then you get your Social Security tax-free. That's 6 different streams of tax-free income. I tell people all the time, who would you rather deal with? What advisor would you rather deal with? Somebody that says you should put all your money into cash value life insurance, or somebody that says we're going to help you take advantage of every nook and cranny of the IRS tax code with 6 different streams of tax-free income, all of which we can justify because they all do something slightly different. And advisors always say, oh, I'd rather be the advisor that does the 6 streams of tax-free. I'd rather work with the advisor that offers the 6 streams of tax-free income. And then I said, okay, well then which advisor would you rather be? Right? And they all agreed that they should take that balanced, comprehensive approach. And so I've been trying to preach this from the stage and from my books and from my podcasts. And hopefully the message is hitting home.
The more I'm learning about reverse mortgages, the more I'm realizing that I need to get more educated and share with more people that this is a tool. Are you a fan? What are your thoughts on reverse mortgages, pros and cons?
No, I didn't. I didn't used to be a fan, and then people like Don Graves and Harlan Akula, they educated me on it several years ago. And here's the most compelling argument for why I like reverse mortgages. Let's say you've got a mom that's got $5 million, and she also has a house that's fully paid for. Would you rather inherit the house or would you rather inherit the money? Well, only 1% of children want to inherit their parents' house. Why? And if they do inherit it, they end up selling it at a fire sale, so they end up losing it, losing money on it. So why not let those assets continue to grow, which is what the children really want to receive at the end of the day anyway, and have the parents spend down the house along the way. So then the house, they don't have to worry about the equity in the house. That's been spent down during their lifetime, and that gave them the luxury of allowing some or all of those stock market assets to continue to grow and compound over time. And that's what people really want to inherit at the end of the day. They want to inherit the assets, not the house. So why not spend down the house, let the assets continue to grow and compound? So I think and I'm obviously just touching the surface here, but I think that it's a really, really interesting tool that can be woven into the complement of tax-free alternatives.
I just had an in-person sit down with Harlan, and I knew a lot of those talking points, but then he shared with me some tax strategies that are available. The fact that you have the government insuring so that you're almost like limit, because debt in any time can be risky and you have to factor in risk. And with a reverse mortgage, when set up and used properly, you are eliminating a lot of like the downside to that. And so that was interesting. And again, it's just another form of a volatility buffer, another form of options. And he shared with me that there's people that get these things and don't even use them, but it's like at least establish the option versus not. And it's made me rethink about this because I've even thinking about like my parents and some of our clients that don't need to do anything from a standpoint to like make ends meet, but from an efficiency standpoint, should be aware of that. Another thing is annuities. What's your thoughts of annuities? When do you like them, and when do you think they're overpitched?
I generally love annuities. I think that in our advisor network, they typically use them in one of two ways. They use it as a bond alternative. So it's the old Tom Hegna approach: reach in your portfolio, remove the bonds, replace them with an annuity, and you'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. And there's been a lot of studies that have borne that out. I mean, annuity companies just know how to manage risk better over time, and I think that the numbers bear that out. And the other way that advisors use this is just as a way to plug the income hole and the income shortfall in retirement. So if you need 100,000 per year and you've got 40,000 covered by Social Security, 10,000 covered by a pension, hand over a portion of your liquid retirement savings to an insurance company in exchange for a guaranteed lifetime stream of income that's guaranteed to last as long as you do. And I love it. And then whatever's in your stock portfolio can be used to pay for discretionary expenses along the way. And you've got your cash value life insurance that allows you to pay for your discretionary expenses out of your cash value life insurance in a year following the down year in the market, so that your stock portfolio can recover before you start paying for more discretionary expenses out of your stock portfolio. So I love annuities, whether you're using it as a bond alternative or as guaranteed income for life. I think they're great applications. There's a lot of great studies. Just at our POZ Summit in Florida, we had Michael Finca, who just gave a banner presentation on guaranteed lifetime income. And every time I hear these PhDs talk about it, I'm further convinced that Americans need to wake up to the realities of guaranteed lifetime income and all of the benefits, psychological and otherwise, that can flow from them.
I love it. I had Curtis Cloak on, and he has a great analogy of your money is hostage. So free the hostages, buy income, create more liquidity. You're creating more options, and it could either be more liquidity for you to use while you're alive, or more to pass on to the next generation. And if you think about it that way, most people are going through life and they're just tying up their money and they think they might be liquid because they see an account balance, but all of that is utilized inefficiently to create a stream of income that's potentially underwhelming. And so yeah, I'm a fan of how these all can be used. Question for you: I've told you this off air. My goal this year is to interview Dave Ramsey. I could be crazy. I think it's going to happen. I'm just going to like put that out. If you had any question that you would ask, like that I would ask on your behalf, obviously you would want to be respectful. Would if you had a sit down with Dave Ramsey and it wasn't like confrontational, like what would you ask him? Um, and I'll see if I can pull it off. If I can make
Yeah.
it happen.
Yeah, I think I would probably start by saying, look, Dave, we all acknowledge that you have to have um, sort of a model for people to emulate. You have to have some sort of roadmap for people, and it has to be standardized and generally one size fits all. And because if you're purveying financial advice to the masses, it does have to be one size fits all. So we acknowledge that. We're not penalizing you, Dave. We understand that in your position, you need to acknowledge that, and that's how you have to sort of package your information. But then I would also ask him what he thinks about the studies that show that utilizing cash value life insurance and annuities in concert with precisely the type of investing that you're talking about, Dave, which he has 4 different mutual funds that he recommends. What do you think about the studies that demonstrate that when utilized strategically, this cash
Yeah.
value life insurance and annuities in concert with investing can increase the likelihood that people's money is going to last longer and increase the likelihood that it will last through life expectancy, increase the income levels, increase the money that's going to the next generation? What do you think about those studies? Do you allow that some of those studies could be right, or are you so sort of concentrated on your particular paradigm that you wouldn't
Yeah.
even contemplate the implications of those types of studies? I
Yeah.
really would like to know what he thinks about the math behind some of these studies.
Yeah.
Is it just a bunch of nerds in the parents' basements that are punching on calculators, or is there an application for these types of strategies in the real world?
One thing that Dave does a really, really good job of is he constantly references their study that they did. And I've no doubt that it was a study that they interviewed tons of millionaires and they heard kind of what they want. And I'll assume that it was as independent as they're saying it was. And that's kind of the thing that they built an empire off of. We've done the study. It's not, don't just take my word for it. It's a study. If you're going to go down that route though, you also have to be aware of other independent studies and at least be able to comment on it. I love that approach because I do think going that route is the best outcome for at least some type of a conversation, because it won't, some of the infinite banking stuff, I think that's just too extreme. I think it's too, like, I think it would even be a mistake to even bring that up. I think the conversation would be, would life insurance, if set up and used properly, integrated into the things that you're currently talking about, is there a play? And if there's a play, then it opens up the door to have conversations about what other places life insurance could fit in. But if if there's no openness there, then nothing else matters. It's just like, okay, we can agree to disagree. You're essentially saying your study trumps all the other studies out there, and then we can have a conversation slash debate around who's right or who's wrong. And I would be shocked if he would even open the door slightly, but it
Yeah.
would be you. But let me ask you this: it's 2026. I find that I do respect people that say, "Hey, I was wrong," or "Hey, there are nuances." Do you think that would be damaging to his brand? Because the people that actually look into that aren't the people, like most people that need to cut up their credit cards aren't going to be watching an interview of Dave Ramsey talking about that. Like, do you think it would actually be damaging, or do you think it actually would build a lot of goodwill? He could stay consistent to his radio audience, but then he could say, yeah, there's obviously exceptions to the rule. And another thing he should say is, yeah, debt does make sense in some cases. It lowers risk. That's another conversation I want to have with him. I'm like, Dave, I have the money to pay off my house, and I get anxious even thinking about doing that. Where am I going wrong here? And again, I don't. I think that would even be way more extreme than the life insurance thing. But like, I wonder behind the scenes, if cameras weren't rolling, he'd be like, okay, I totally get what you're saying. It would be really damaging for me to say. But do you think like in 2026, like people will they actually like gain more respect for someone who's willing to dialogue a little bit more?
Yeah, so I've thought about this long and hard. If Dave were to ever, you know, open the door to life insurance or annuities, here's the danger. If Dave says that he was wrong or too aggressive or too inflexible on one of these platforms, or even that he was wrong about the 8% rule. I mean, he's been telling people for years that you can take 8% sustainable withdrawal rates out of your portfolio. If you're in the stock market, the stock market's going to deposit 10% into your bank account every January 1st. So you can therefore take 8% out and never run out of money. Like that's a pretty important platform of retirement planning. And for him to have been off by a factor of 100%, right? Like
Yeah.
sustainable draw rate's 4%. Dave, you've been telling people it's 8%, and the people who say 4% are nerds, they're lemmings leading people over a cliff, right? So I think that here's the danger. If he were to say, I was wrong about the 8% rule, I think people are going to say, okay, if he was wrong about something as important as sustainable withdrawal rates in retirement, what else was he wrong about? What else is he not telling us? And then all of a sudden you have the potential for the floodgates to open, and now people are
I see.
starting to doubt everything that he says. So I don't think he has the luxury of nuance. I don't think he will ever open the door to life
Yeah.
insurance or annuities. He's got to be super, super hidebound about it. And so I don't think that even if you got the interview with him, that he would
Okay.
show any sort of
I
flexibility on that.
I appreciate that optimism from you, the realist. I like that.
Yes.
David, is there anything else you want to say before we land the plane? This has been a pleasure having you on. I mean, you're making videos. You're gonna surpass 100,000 subscribers this year on YouTube. Congrats, by the way, on that. It Talk to me about anything else that you're researching, you're excited about, anything else that our audience should know before we sign off.
No, I would just say don't get lulled into a false sense of security. It's easy in the wake of in the wake of them permanently extending the Trump 2017 tax cuts. It's easy to say, hey, look, all of that. Dave was just he was just being an alarmist. He was trying to set the world on fire with all these crazy apocalyptic warnings. And now not only are taxes not going down, they've been extended. These low tax rates have been extended for another, infinitely, right? I would just don't get your hopes up. Don't rest on your laurels here, because
Yep.
those tax rates can go up. They will go up, and you have a finite window within which to take advantage of historically low tax rates. I'm updating Power Zero through Penguin Random House. It's going to come out in April. And I renamed Chapter 6 from the tax sale of a lifetime to the temporary permanent tax cut. There's no such thing as a permanent tax cut. This
Yeah.
is a temporary permanent tax cut. I think that as we move forward in time, we should treat it as such, and then we should sort of plan accordingly.
It's permanent in pencil.
That's
P
right.
stands for pencil, right?
That's right. That's right.
I love that. David, thank you. We'll make sure to include any links that you want down below in our description. And as always, it's a pleasure, and look forward to having you back on here in the near future.
Thanks, Gail. It's been a lot of fun.
My producer just told me something wild. Only 6% of you who have subscribed to our channel have enabled notifications for our videos. That means 94% of you watching right now won't get told by YouTube when we upload a new video. So whether you're brand new or one of our longtime subscribers, if any of our 1,000+ videos have helped you think differently or brought you value in any way, I'd love for you to hit that bell and turn on all notifications. We've got some incredible guests and conversations planned for 2026, and I don't want you to miss them. Thank you so much for supporting this channel, and I'm excited to keep growing with you.